John Wick here. I'm excited today to bring you my very first ever option lecture series, and today we'll be covering call options. Now, a little background on me. I do have, almost 16 years now of full-time option trading experience, so hopefully I do a good job here in giving you guys some more information and helping you to embrace options a little more. That said, let's get stuck into our disclaimer. This video is for entertainment and educational purposes only. Any information spoken or written about in this lecture or future lectures or lessons should never be interpreted as financial advice. I am not a financial advisor. Trading can be extremely risky and options can be even riskier. I do not assume any liability for your decisions or actions as a trader. I'm simply sharing my own experiences and my own perceived insight from those experiences. Today, we'll be covering what are options, what is a call option, characteristics of call options, buying and selling call options, and then we'll end the lecture on a covered call strategy, which I'm excited to teach you guys about, so stick around. That said, guys, know that this is brought to you by FTX. They are sponsoring me. And they do allow option trading on Bitcoin, and they are also the leader in DeFi. So go check them out, please. Okay, so let's get started. What are options? Options are leveraged instruments of an asset class, and it can be on many different asset classes. Options are used to speculate, to hedge, or to derive an income. If you're trying to speculate, you're simply either buying a call and betting that the asset price goes up, or buying a put and betting the asset price goes down. If you're hedging, you're simply buying a put option, which I'll get to in a later video, and you're using it as insurance. If you're deriving an income from options, you're doing what I'm doing on my SPX trades that you guys see me tweeting about on Twitter 3 times a week. That's deriving an income, mainly selling options, selling puts and calls. There are 2 types of options, of course. There's call options and there's put options that I've been talking about. When we think of options, we normally tie them to the stock market. That's what we predominantly think about when anyone mentions options. But as said, they're used on many different asset classes, and there's also a whole new world of option trading on cryptocurrency that is also opened up. Okay, so let's get into some characteristics of options. First, we have our strike price. Now, your strike price is chosen by the trader. It's based upon where he thinks the asset's price will or will not go. And it's chosen by the trader before he puts on absolutely every options trade. You got to know where your levels are. Now, also keep in mind that when you pick a strike price, normally if you are selling calls, you are picking a strike price above the current price, right? Because you want to pick a level or an area that the price action will not go above if you're selling options. And if you're buying options, you want to pick a level where you do think that the price action will climb above. Next is expiration. The expiration date is the date that the trade ends. It is a chosen and carefully selected date by the trader before he puts on every single trade. So with an expiration, you're basically picking a date that you think that the assets, if you're buying a call option, will go above your strike price within that allotted amount of time. If you pick too short of an expiration, you might not give your asset enough time to breach above that strike price if you're, say, buying a call. Okay, we go on to premium. Now, premium is the fee paid for taking the bet or options trade. Okay, the buyer pays this premium to take the bet, and the seller receives this premium for facilitating the bet. You can be either a buyer or seller of premium, or options, should I say. Next is the contract multiplier. Now, this is a bit of a confusing subject for a lot of people, that being because on every different asset that trades options, the contract multiplier is a bit different. Like a stock option, one contract on a stock option would be equal to 100 shares, and one contract on Bitcoin would be equal to 1 Bitcoin when you're trading options. So let's look into that a little bit more. We have stocks and crypto, right? Trading options. That's what a lot of us have come to watch this video for. With stocks, one call contract equals 100 shares of the underlying stock. So for instance, one Apple call contract would be equal to 100 Apple shares. So if you bought an Apple call contract, you would pretty much be participating in the upside price action, if you were right, of 100 shares of Apple. Now, when you go look at the pricing of option contracts and call contracts, you might see that they don't cost that much. You might see that one Apple call contract might cost $2 for the strike price you're trying to pick. Now, that doesn't mean that you're paying $2 for this call option, because remember, for every one call contract, it equals to 100 shares. So $2 times 100 shares is actually $200. So that's how much you would be paying for that call option. And that's a good start for to lead us into the cryptocurrency trading of Bitcoin. Now, it's the same concept, right? Except for every call contract is equal to 1 Bitcoin. Now, they do offer fractional contracts that are available on exchanges like FTX. But let's say that you only wanted to buy half a Bitcoin contract because you only wanted to cover half a Bitcoin. Well, in that case, on FTX, say, you would go and type in the quote for half a Bitcoin. They would quote you the price on a full Bitcoin, and you would simply be paying half that amount because you're buying half the contract of a full Bitcoin. So that's also important to understand. Okay, let's move on to what is an option? What is a call option? We're going to cover buying and selling. We're going to go over the use cases and also the risks involved in each. So if you are buying a call option, you are long a position. You're speculating that you want to go long an asset for a fraction of the cost that it would normally cost you. So for instance, let's say that you wanted to buy call options on Bitcoin. Well, if you wanted to participate in the price action with Bitcoin alone, you'd pay $11,000 per Bitcoin, and then you would participate in that price action to the upside. Well, if you buy a call contract, you might get that same position for maybe a couple $100, $300-400 maybe, right? And you would participate in almost the exact same price action to the upside if Bitcoin started climbing. So let's go over the risks in buying a call option. The risks in buying a call option are limited to the amount of capital that you pay for that call option. So the premium that you pay is the maximum amount that you can lose on the trade. You can't lose any more. So if we had to compare that, let's say you bought a whole Bitcoin at $11,000, your maximum hypothetical risk is, well, $11,000. On a call contract, if you buy it for $300, well, your maximum risk if Bitcoin went to zero is just $300. Okay, so let's move on to selling call options, which is a short position. Its use cases, it can be used to hedging an existing position. Okay, this would be if your position is, you think it's going to go through a bit of weakness, but you don't want to let go of the long position. You might sell a call contract against an existing long position to hedge it. Okay. You can also sell call options to reduce your position's cost basis. Now, I did this on Bitcoin last year. I think for about 6 or 7 months, every month, I would sell a call contract way above the price, and I would take in a premium. And every single month, I would take in that premium and use it to offset the cost basis of all the Bitcoins that I have. And that was my goal. And lastly, you can use selling call options to derive an income. You guys see me doing this every week on Twitter when I sell my SPX contracts. I'm selling calls and puts, right? It's the same concept. Now, you have to know the risks involved with selling call contracts. You have unlimited risk, so you have to be careful. And when you are selling a call contract and you don't own the underlying asset, that is called a naked position. So you actually have naked calls and you have naked puts. When I am selling my SPX trades, I am selling naked calls and naked puts. The risk is unlimited, so I would say that if you're going to be selling calls, you should own the underlying asset and turn it into a covered call, which I'll go over at a later stage in this lesson. But I would say that you should not sell calls if you're not a professional and don't have experience in option trading, because it is extremely risky, guys. Okay, buying call options, again, which is not risky at all. It's a bullish trade, and you're paying a fraction of the amount that you would normally pay for the asset to participate in the same upside price action, right? So that's the edge in buying call contracts. The maximum risk, as we went over, is the amount that you pay for the call contract. You can only lose the premium that you pay, no more. Now, the next edge in buying call contracts is obviously there's no liquidation, right? You just lose all your premium if you are wrong on the call contract by expiration. I'll also say that for selling call contracts, there is no liquidation on options. Now, I know a lot of you guys, some of you guys that have read up on options trading might say, but John, it does say that you can get exercised if your position's underwater enough. So let's talk about that. In my 16 years of trading options, I have had many losers like any trader. I've had bad losers, but I've never been exercised in the 16 years that I've been trading options, not once. Okay, so that leaves me to believe that there's no liquidations. It can happen, right? I believe it will happen to some very unlucky folk, but don't count on it, right? You can have an option. I've had option contracts that have gone underwater so bad and have been there until the last, day 2 or 3 days before expiration, come back up and turn into a profitable trade. And that's the edge when you compare trading options to trading leverage. But let's move on and stay on course here. Let's go over characteristics of a long call option. So again, first we have our strike price, and a lot of this stuff, guys, is going to be a little bit redundant and repetitive. I'm doing that on purpose to help you guys maybe retain a bit more of the information. So strike price here. For buying a long call option, this trader will choose this strike price based upon how high that he thinks the asset might go in the allotted time frame that he has chosen with his expiration date. Okay, so if you have Microsoft, and let's just say Microsoft is trading at $100 per share, and you think that it's going to go up to $130 per share, you might buy, 110 call option, right? And it'll go above that price, and when it does go above your strike price, you go into profit. Next is expiration. We've been talking about this. And this is when your trade comes to an end. Either your asset is above your call strike and you're profitable, or it is not and you lose the premium that you paid. Brings us to premium. So premium for the buyer is the amount you pay in order to have the right to buy the asset at a selected strike price, even if that asset goes above your strike price by expiration. Now, this is getting more into the formal definitions, which I try to stay away from. I haven't really read the definitions and options in, probably over 10 years. But yeah, in layman's terms, premium is the money you buy as a call option buyer, and the money that you pay. And if you're selling call options, it's the money that you receive. Okay, guys, the bell curve is next. You probably need to look this up on the internet. It's very useful. The bell curve will kind of tell you how fast your time value is eroding in your options value. Now, if you go read my Discord, you'll read about time value, and I'll get more into extrinsic and intrinsic value. But just know that if you're buying an option or you're selling an option, the value of that option will start to deteriorate at a faster rate the closer you get to expiration. So that means if you're buying a call option or selling a call option, this will affect when you want to close the call option, right? If the call option is not doing well and you're getting closer and closer to expiration, you might want to close that call option out before it starts to erode the value at a faster rate. Now, guys, I know that's a bit complicated. I will be going over the Greek tutorial of options at a later lesson in much more detail, so don't worry about that. So when to buy call options? There's two primary opportunities for buying call options. One is when we have dips within an overall uptrending bull market, right? When it's pulling back and it's within a bull market and you have a little bit of a correction or a little bit of a pullback, those are beautiful times to be buying call options, right? And the next opportunity is going to lie where you have low volatility. So when you have low volatility, you have cheap options. Your option premiums are cheaper. Conversely, when volatility rises, you have expensive option premiums. So if you're buying call options, it makes sense that you never want to buy call options when volatility is high. You want to buy call options when volatility is cheap and low. Also, make sure that you never buy call options in a down bear market. That is just, you're trading with the probabilities against you. So now let's go over where to buy call options. Now, in a bull market, a lot of times it's known that price action a lot of times will pull back to that 20-day moving average. So in this chart right here, you can see that we have a very clear uptrend, a very clear bull market. And you can see that this price action, I've put these little green arrows to show you opportunities where it would have been a good time to buy call options. You can also see that it breaks out here and then pulls back close to this 20-day moving average, which is what this line is. So here would have been a good time to buy calls. Went up, made you profit, closed out. Here would have been a good time. Pulled back again to the 20-day. And once again, and guys, this chart went on like this. So that is a great time to buy call options. Next, during a breakout of resistance or a volatility breakout. So if you guys do follow my indicators, you will know that we have these shaded areas followed by a volatility breakout arrow, a green arrow. So these arrows, I wasn't meaning to put this in here at first, but I thought it was a good idea. So if you're trading volatility, these green arrows also, as you can see, would have been a great time to buy call options. Next, we move on to consolidation and accumulation phases. So this isn't one of my favorite times to buy call options, but for some people, this is their entire strategy. So as you know, with Bitcoin and cryptocurrencies, you've seen this a lot of times where the asset will go into a stage 4 downtrend and then form a base and go into consolidation after that, which is a stage 1 basing. And that can sometimes be a good time to buy call options because, well, after bases, it can possibly break out to the upside in a stage 2 uptrend. Okay, I'm kind of teaching you guys psychoanalysis here, but yeah, so that consolidation can be a good time to buy, and just make sure that if it does break to the downside, that you're ready and you know where to close your call options. You can even set stops on your call options on stocks. I believe they don't have stop losses yet on cryptocurrencies. Now we look at long pattern setups. They are also an excellent time to buy call options. This is going to be your head and shoulders, your double bottoms, your cup and handles. All those 3 patterns I actually like a lot, but there's many long patterns, and they would be excellent opportunities to buy call options. We'll get into the charting a little bit more here. You can also see that when we have support, right, it's also a good time to buy call options. Now, this is one of my indicators. I have not drawn all these lines, but you can see here, if you had bought a call option at support, you would have been good here and here as well. Another time to buy call options is also when you go through a period of when the asset is oversold, okay? So if you look on the chart here, these 9s here, these green 9s show levels of oversold. If you would have bought a call option here, okay, you would have been in profit. If you would have bought a call option on the 8, you would have been in profit. I normally like the 9s, but you can see here, anytime we have oversold status, it can be a good opportunity to have high probabilities of a call option, long call option, working out in your favor. Moving on, let's talk about selling call options. Now, selling call options is a bearish trade. You're betting that the asset's price will either stay going sideways or go down, and you can be profitable in both scenarios with selling call options. Something that you also cannot do on leverage exchanges. If you're short and it goes sideways, you do not make money. That's not the case with options. So with selling call options, you can collect a guaranteed premium for selling the option. Okay. What this means that if you're selling call options, you're taking that premium for facilitating the bet. Well, you never lose that premium. You will always get that premium no matter if you're right or wrong. Now, that doesn't mean that your actual call option can't go underwater and become a losing trade, but you will always keep that premium to at least offset any losses on your call contract. So you can collect an income selling call options. You guys see me doing this on my SPX trades again on Twitter. There's no liquidation with options. We went over that. So it's got a big edge compared to trading on leverage exchanges, which in my opinion, guys, it's just gambling. Naked call options carry unlimited risk for the seller. So again, know that if you do not own the underlying asset and you also sell a call option, okay, without owning it, it's a naked position and it's unlimited risk, guys. Now you can change that by doing covered call options, and I'll explain that later. Since we do carry so much risk just selling options and selling calls by themselves, it's always a good idea to use stop losses and set alerts if your exchanges offer that. But ultimately, this comes down to always knowing where you're going to close the trade. Okay, so you need to know that, guys. You need to know by looking at your asset, by doing technical analysis, or however you analyze it, you need to know when you're going to get out of the trade. So let's talk about some characteristics of short call options. We'll start with premium again. So premium for the seller of options is the amount of money you receive for facilitating the buyer's request to buy the call option at your selected strike price. Obviously, they look at that strike price and they have the opposite bias in mind. So we move on to implied volatility. Now, again, guys, this is kind of just touching almost on the Greeks, right? We'll get into that, and don't be alarmed if this is a bit much for you. Again, I'll have a whole lecture series on the Greeks as well later on. But for starting off, implied volatility, also referred to as IV. And when IV is low, options are cheap. When IV is high, options are expensive. Know what the IV is before you're going to put on the trade. You'll know if you have a higher probability of the trade working out or not. And you also want to buy call options again when IV is low. We move on to theta. This is part of the Greeks and one of my favorite Greeks. Theta is the amount that you will be receiving from any decaying time value. It's important to traders who are trying to trade and make an income or derive an income. So for me, how I think about theta, it's tied to time value. And for me, the amount of theta that I have represents the amount of money that I'm making on short call options every single day, no matter what the stock does. So again, this is the beauty about call options versus leverage or anything else. If your asset is going sideways and you're selling call options and you have those call options open, every day you're going to have a theta amount, and that's the amount that you're going to be making no matter if the asset even goes sideways, guys. Sideways or down. Next, we move on to delta. Delta is also another one of my favorite Greeks that we will be teaching in detail in a later lesson. But for now, know that delta is viewed upon by some traders as a means to measure risk and probability of when to sell call options, right? It can help you increase your chances of it being a successful trade. A lot of guys will pick a certain delta in certain market environments and only sell call options that have that strike price that meets that delta. Again, we'll go over this in more detail at a later lesson, guys. Don't worry too much about the Greeks here. When to sell call options? Okay, well, there's two primary opportunities for selling call options. One is during consolidation or during a temporary corrections within a down bear market. Okay. And the next opportunity for selling call options is when volatility is high and option premiums are expensive. Now, why do you want to wait until option premiums are expensive? Well, if you're the option seller, that premium is the profit that you're making on your trade, right? So it stands to reason that the more expensive the premiums are, the better it is for you as a seller. Now, guys, just like we had hard rules with the buying call option contracts, our hard rule here with selling call options is never sell call options in a stage 2 bull market. So if you have an uptrending strong bull market, don't even think about selling calls. Now let's move on to where do we sell call options? Well, after long run-ups when the market is overbought, during signs of weakness, at the start of a price reversal or above resistance is a good place to sell call options. And then again, also based upon the delta fitting your risk profile. So let's look at the chart a little bit closer. Okay, so if we're looking at this chart here, beforehand, when we were looking at buying call options, we did say that when there are levels of oversold, like these 9s, it would be a good time to buy call options. So conversely, these red 9s, which show the opposite, they show overbought status, would be a good time to sell call options. As you can see, if you had sold a week out call option, this would have been just fine. You could have even resold it. Let's see, on this 9 here, 7 days out, you would have been profitable. The 9 was right here. You would have sold your strike price maybe somewhere here, betting that the price action could not go above this level, and you were 100% profitable. Let's even look at this 9, which is right here. If we went 7 days out, 1, 2, 3, 4, 5, 6, 7, right here. So let's see, the 9 is here. This would have been close. I think you actually would have been fine. The next 9 is over here, and you would have sold your strike price about right here, and you would have been fine again. So out of 1, 2, 3, 4, 5, out of 5 9s, there was maybe one that was questionable, right? So those are good times to sell call options. Again, if we look at these resistance levels, and you remember that I told you selling above resistance is a good time, is a good opportunity to sell call options. If you would have sold above this resistance, you would have been fine. If you would have sold above this resistance for 7 days, you would have been fine again. Here as well, again, this is a bit iffy, all right? But you can see above resistance is normally a good probability to sell call options. Okay, so now let's get into selling covered call options. And I'm really excited about this because this is a very basic but powerful strategy, and it's one of my favorite strategies today. In fact, I actually just did this on gold when I bought some gold recently. So the strategy requirements, well, you have to own the asset. For a short call to become a covered call, the only difference is that you have to buy the asset and physically own it. Okay. Next, after owning the asset, you have to sell a call option on that asset above its current price, right? You don't want to sell a call option below what the current price is, because then you'll definitely have a higher probability of a losing trade. Always above the current price, guys. Now, with covered call options, you can generate revenue on assets that you already own or that you believe are going to go up in price action. You just have to be very selective on where you sell that call option, because if you do sell a call option and your asset goes above that strike price, you will have to give your asset away at that strike price, even though it's gone above your strike price. Now, keep in mind, you will be profitable, and that will be a profitable trade because you were owning the asset from way below that strike price. So the appreciation from the actual asset, you made money, and you'll also make money on the call option itself. So let's move on to the benefits here from implementing covered call options. Well, the cost basis of the asset will be reduced by the premium you're receiving and taking in as a seller. Okay, so every month, again, like I was selling Bitcoin last year, I was selling call options against Bitcoin, and taking that premium in every single month. And I was, again, using that to offset the cost basis of my overall Bitcoin, let's call it Bitcoin fund, right? So that's how you reduce cost basis by selling covered calls. You can also create an income from your long assets. Again, this is the same thing every month or week or whatever your time frame is. You would keep selling calls. And this way you would again have price appreciation on your asset, but also a monthly revenue coming from selling call options until your asset goes above your strike price, which isn't a bad thing. That means you've gotten the absolute maximum profit on your trade from both your long asset and your call option. You can use it to hedge existing positions. So let's say you have a position, asset, and it's gone up in price action, and you think it's going to go through some areas of weakness, but you don't really want to get rid of it. You think that asset is going to keep climbing later on. So that's an excellent time to hedge that position, right? Not sell it, but hedge it by selling some call options. That way, if the asset goes down in price action, you'll have a little bit of a buffer from that premium that you took in. So what is the maximum risk of selling a covered call? Well, unlike a naked call, you have the asset to cover you. So even though your call option will be losing money in value as the asset climbs higher, you actually own the asset. So you'll be making money on the asset itself. So it kind of evens each other out, right? So that is why I like covered calls versus naked short calls alone, because the risk profile is completely different. You can feel very comfortable selling covered calls, knowing that the only risk is really you might lose profit potential, right? You might have a stock that keeps going up and you have to give it away and now it's a lot higher. That is the risk you take. But let's be honest, guys, nothing goes up forever. So that is why I'm a fan of selling call options and covered call options continuously. So let's go over some characteristics of covered call options. Now these will be a little bit different, guys. I'm putting these I'm putting in what I think is important for you guys to understand. So we'll start with the asset itself, which is most important. So make a trade plan for the asset as the asset carries the most risk, more than the option call itself. Stick to your trade plan and base your short entries on your asset's price action, okay? So what I mean by that is when I was a beginning option trader, I would get so excited, about this new world of options that I would focus on the option being profitable, and I would lose focus on the actual asset itself that I owned, and would, focus on the call option. That was the wrong way to do it because the asset itself holds more risk. Okay, so you would trade these covered call options just like you would trade any asset. You would watch the price action of the asset itself. You would pick your levels to exit the asset, based upon the asset's price action. So based upon, let's say, Bitcoin, you would stick to your game plan and your trade plan, and the covered calls would not change that at all. It should not change that for you. Understand your goal. Understand the goal of the sale. Know what you're trying to accomplish before you put on the trade, guys. Are you hedging? Are you trying to reduce cost basis? Or are you trying to derive and create an income? These are all a little bit different, or different methods of execution. Let's talk about closing the call early. Now, guys, it's never a bad idea to take profit, as you know. Positions can be resold and rolled more than once, meaning that, if you close out a call option in profit, you can resell it. You can wait for another period of, overbought status or, close to a resistance level and sell more calls. So never be scared to close out a call early, especially if it's a losing trade. And then lastly, let's talk about theta. Again, theta is the amount that you will be receiving daily from decaying time value. This is especially important for income strategy traders. So let's go over an example. So one example for stocks is, let's say, Microsoft. On a covered call, you would buy 100 shares of Microsoft. And let's say it's going for $100 a share. After that, you would sell one call contract, and let's say you sold it with $120 strike price. And let's say that you picked 30 days out as your expiration date. Let's also say that you took in $4 of premium for selling this covered call contract. So let's examine that and see what that really means. So you bought Microsoft at $100, and since you sold the call strike at $120, you're betting that the asset will not go above $120 within 30 days. And again, you feel good about those probabilities, and you've taken in some premium for your analysis and your bet. Now, let's say that expiration comes and Microsoft goes above your strike price of $120, and let's say it settles at $122 at expiration. What does that mean? Well, that means you have to give your Microsoft shares away for $120, your strike price, even though it is now worth $122. So on this trade alone, when you look at it, you would say to yourself, okay, well, this didn't work out as good because, well, I lost $2 when I could have been up $2 per share, right? On 100 shares, that's $200. But let's analyze this a little closer. So you actually made $20 profit per share. It went from $100 to $120 before you had to give it up, right? So, $20 times 100 shares, well, that's $2,000 profit that you made just on the stock appreciation from it going from $100 to $120. You also made $4 per share for selling the call contract. Now remember, one call contract will equal 100 shares. So you actually made $400 selling that call contract. In total, you made $2,400. Okay? So now if we just take a step back and we look at this here, you actually would have made, let's see, on this right here, yeah, $200. So you actually made more money. Sorry about that, guys. You actually made more money selling the covered call option. So now let's look at cryptocurrency. Cryptocurrency on a covered call, you would buy one Bitcoin, let's say for $11,000, or let's say you owned a Bitcoin already. You would then sell one call contract with an $11,100 strike, because remember, you want to sell strike prices above what the current asset's price is. And let's say you sell that $11,100 strike price and you have an expiration for 30 days out is when your trade expires. So let's say you take in $200 premium for selling that covered call, call contract. And let's say Bitcoin goes above your strike price and it goes to $11,200 at expiration. This means that you give your Bitcoin away for $1,100 because that was your strike price selected, even though the price is worth $11,200. So you're $100 short. Again, let's look into this in more detail. Well, you made $100 on Bitcoin's price action appreciation because it went from, $11,000 to $11,100 right before you had to give it away. So you made $100 there. You also made $200 for selling the call contract. So in total, you made $300 profit. Now you can buy Bitcoin back and sell another call contract if you want to. That is actually one of my strategies whenever the market environment is appropriate. So let's talk about cash settled versus physically settled exchanges. So again, this is one of the most complicated aspects to understand for most beginning traders when they start trying to learn options and also trade them on cryptocurrency exchanges. And this is because cryptocurrency exchanges like FTX and all the other exchanges that offer cryptocurrency options, they are all cash settled exchanges. And that is different from the stock market, which is physically settled exchanges. So let me go over the few of the differences and clear up some of the misunderstandings. So if you are, we'll start with cash settled. If you are selling a call option and you don't own the underlying asset, well, as we know now, that's called a naked call. And that means that it carries unlimited risk. So that is still the same on a cash settled exchange. If we move to buying call options, okay, if you buy call options at your expiration, you're either going to be right or wrong, and it's simply settled in a dollar amount. It's either a debt if you're wrong or a cash gain if you're right, settled in dollars. Now, as I've said, the selling calls on these cash settled exchanges is very risky, and that's why I try to teach you guys in this lesson about covered calls, which is a completely different risk profile, and I'll explain how. So if you're trying to execute a covered call, as I've noted, you have to either buy Bitcoin or keep enough Bitcoin to cover the amount of short calls that you're selling. So you would either keep that Bitcoin on a separate exchange or in your wallet, or even on FTX if you want to buy the Bitcoin there and you understand the risks, right, of keeping Bitcoins on an exchange. If you're okay with that and you sell call options on FTX, let's say the asset or Bitcoin goes above your strike price after you've shorted a call option. That means you're going to take a loss on the trade. But if you own the underlying asset, you'll take a loss on the call option as it goes above your strike price and continues to climb higher. But you'll take a gain on your actual Bitcoin, right? So it kind of offsets each other, right? And that's why it changes the risk profile completely when you do a covered call versus when you're selling naked calls without the underlying. Now, no action is needed at expiration if you're just selling regular calls or buying regular calls on a cash settled exchange. Again, if you're right on your long call, you'll simply be settled in a cash gain in dollars. And if you're wrong on your long call, you'll be settled in a loss on the premium that you paid. If you're selling calls and you're right on your assumption, again, you'll be settled in a cash dollar amount. And if you're wrong, you'll be settled in a loss for a cash dollar debt. Now let's move on to physically settled exchanges for the stock market. If you're selling calls and you don't own the underlying, it's exactly the same as a cash settled exchange. It's considered a naked call and it's unlimited risk. If you're buying calls, you have to close the long call before expiration if you're profitable, if you don't want to own and buy the underlying asset. The way it works is that if you buy a call option and your asset goes above your strike price and expiration approaches, you either have the option to close out that long call and net the gain on it in a cash amount, just like a cash settled exchange before the expiration. Or if you really like the asset still and you think that it's still going to have some upside potential, you'll have the option to actually buy that asset at your strike price during expiration. So again, let's say you bought Microsoft or you bought a Microsoft call at $130 and you don't own the underlying asset. And let's say Microsoft goes to $190. Well, that means at expiration, you will have the option to buy Microsoft at $130, even though it's worth $190. So you have that option in a physically settled exchange, which is the main difference between that and a cash settled exchange, is that you simply have the option to close it out before expiration or take assignment on expiration. Now, again, you can do covered calls in a physically settled exchanges. They can be done exactly the same by simply owning enough shares to cover the amount of calls that you're selling against it. Now, no action is needed at expiration for all different types of calls. If you're okay with buying or receiving the shares at your strike price, you simply buy them. If you're not, you simply close the trade out before expiration and net your gain or loss. So hopefully this cleared up some big misunderstandings between cash settled and physically settled exchanges when you're switching between cryptocurrency options and stock options. Next, we'll get to American versus European options. Okay, European options are generally what crypto is traded in, and stock options are American style options. On European style options, the trade can be closed before expiration, but not exercised before expiration. So you can take no one can take assignment of those shares if you're on the other side of the trade, and you can't be exercised before expiration. So generally the options on a European exchange are a little bit less expensive. Also, most cryptocurrencies, as I've stated, are European exchange type options. Now, when we go to the stock market, again, it's American style options, and you're able to close and exercise the trade at any time before expiration and take assignment or give assignment, right? That is the main difference between American style and European style. Generally, options are a little bit more expensive on American style option exchanges. And again, mostly stocks are going to be what you're trading on American style option exchanges. Now, the biggest difference, again, that I want to reiterate is that with European style options, like on FTX exchange, people assume that you cannot close the trade out before expiration, and that's the biggest misunderstanding that I've seen. Again, you cannot take assignment and buy the shares before expiration or get given the shares before expiration. But you can close the trade, so let that be known, before expiration at any time that you want. You simply just take the net gain or net loss on the position. Okay, guys, well, that wraps up this lesson for today. I hope you enjoyed it. And if you do want some more option content from me, you can visit us at our site, tradingalpha.io, where I do give free option education. You can continue watching and subscribe to our YouTube channel, which I assume that you're watching now. You can join us on our Discord, right? If you click on the information, I'll put the link below. Our Discord channel has over 2,000 members and it's growing really fast. Again, I teach options for free there. My Twitter account is 0hedge_, and the account for Trading Alpha is tradingalpha_. I will tell you that lately we've been working really hard to bring you some really cool things. We're going to be adding more trading videos to both the Discord and the website. We're going to be adding more option strategies. We're going to be adding income strategies, more so like the covered calls, but different strategies. And we're also adding a breakout screener, if you guys have been following the indicators. That does lead me to the website at tradingalpha.io/I. If you do want my indicators, we have a low time frame squeeze, a high time frame squeeze, which catches the volatility breakouts really well. We have wick RSI, wick thrust, and support and resistance. Again, guys, thank you so much for listening to my video. I hope you enjoyed it, and I'll catch everybody soon.